Here's a number that should make you angry. Your savings account is paying you 0.39% interest right now. That's the national average, according to the FDIC as of April 2026. You deposit $10,000, you wait an entire year, and the bank hands you back $39. Meanwhile, that same bank is charging people 23% on their credit card balances, on the same money, in the same building, with the same logo on the door. $39 in, 23% out. And most people have never once stopped to ask why. That gap, that enormous, almost comical gap, is not an accident. It is the single most profitable mechanism in modern banking. And the less you understand it, the more money it makes them. So today, we're going to understand it. Let's start with the most basic question. What is interest? Interest is the price of money. Simple as that. When you borrow money, you pay interest, a percentage charged on top of whatever you borrowed. When you lend money, you earn interest, a percentage paid back to you for letting someone else use your money. Now here's the thing most people miss. When you deposit money into a bank, you are not storing it. You are lending it to the bank. The bank takes your deposit, turns around, and lends it to someone else at a much higher rate. The difference between what they pay you and what they charge the borrower is how they make their money. Bankers call it the net interest spread. You can call it the gap that's quietly draining your wealth. And right now, that gap has never been wider in modern history. Let's put real numbers on this. The average savings account in America pays 0.39% APY as of April 2026. Some of the biggest banks, Chase, Bank of America, Wells Fargo, pay as low as 0.01% to 0.05% on standard savings accounts. That is not a typo, 0.01%. On the other side of the ledger, the average credit card interest rate is sitting at around 23%. The average personal loan rate is between 11 and 20%, and a payday loan, the predatory kind, can charge 300 to 400% annualized. So the bank pays you 0.39%, charges borrowers 23% on credit cards, pockets the difference, and does this with your money. Put $100,000 in a standard Bank of America savings account earning 0.01%, and after 1 year, you have earned $10. 10, a single dinner. Meanwhile, that same bank deployed your money into credit card balances, charging 23% and generated thousands of dollars in interest income. This isn't conspiracy, it's just business, but it is a business that only works if you don't pay attention. So why don't banks just pay more? This is the question people ask once they see the numbers, and the answer is brutally simple. They don't have to. Banks know something important about human behavior. People are lazy about their savings accounts. They open one, set up a direct deposit, and never look at it again. Switching banks feels like admin work. It feels complicated, so most people just don't do it. Banks call this deposit stickiness. Customers keep money in low-yield accounts not because they're happy with the rate, but because inertia is a powerful force. And banks have spent decades designing their products around that inertia. Think about how a bank account works. It's linked to your paycheck, your bills auto-pay from it, your emergency fund sits there. Moving it feels like a project, and banks are perfectly happy for it to feel that way forever. Because every day your money sits in a 0.01% account instead of a 4% high-yield savings account is a day the bank captures the difference. Multiply that by millions of customers and billions of dollars in deposits, and you start to understand the scale of this. Now let's talk about compound interest, the concept banks use against you more than any other. Einstein allegedly called compound interest the eighth wonder of the world. He may or may not have actually said that, but whoever said it was right about the math. Compound interest means you earn interest on your interest. Your balance grows, then you earn interest on the new balance, which grows again, and the cycle repeats. Over time, the growth becomes exponential, not linear. Here's the thing, this principle works both ways. When it works for you in a savings or investment account, it builds wealth quietly in the background. When it works against you on a credit card or loan, it quietly destroys it. If you carry a $5,000 balance on a credit card charging 23% interest and only make minimum payments, you will pay back nearly $11,000 before that debt is gone. You borrowed $5,000. You returned $11,000. The extra $6,000 went directly to the bank, in interest, on money you already spent. That is compound interest working against you. And most people discover this the hard way, not in school, not from their parents, but buried in a credit card statement they barely read. Here's what the banks definitely don't advertise. High-yield savings accounts exist. Online banks with no physical branches and lower overhead costs routinely offer between 3 and 4% APY right now in 2026. Marcus by Goldman Sachs is offering 3.65%. Barclays at 3.70%, Lending Club at 4.00%, some accounts even higher. Put that same $100,000 into a 4% high-yield savings account instead of Bank of America's 0.01% account, and after 1 year, you have earned $4,000 instead of 10. After 10 years with compounding, the difference is staggering. The product exists, the rates are real. The only thing standing between most people and significantly better returns on their cash is the 15 minutes it takes to open a different account. Banks know this, which is why the biggest ones don't advertise their high-yield options. They quietly offer them to customers who ask, but they never lead with them because the business model depends on the majority of customers never asking. And then there's the credit card side of this equation. Credit card companies are legally required to disclose your APR. It is printed on your statement every single month, but they are extremely good at making sure you never think about what it actually means in dollars. The minimum payment trap is the masterpiece of this strategy. Banks set minimum payments at a level so low, often just 1 to 2% of your balance, that at that pace it takes years to pay off even a modest balance. And during every one of those years, interest is compounding. The balance barely moves. The interest keeps stacking. A $2,000 credit card balance at 23% interest, paid off at minimum payments only, takes over a decade to eliminate and costs you more in interest than the original balance. You effectively buy the same thing twice. The bank does not want you to pay your balance off every month. A customer who pays their balance in full every month is called a deadbeat in the credit card industry. Not because they're irresponsible, but because they produce no interest income. The most profitable customer is the one who carries a balance indefinitely, paying just enough each month to stay current, never quite catching up. So what do you actually do with all of this? 3 things, and they're not complicated. First, move your savings. If your money is sitting in a traditional bank account earning less than 1%, move it to a high-yield savings account. 4% exists right now. The process takes 15 minutes online. There is no reason not to do it. Second, understand your credit card APR. Open your statement, find the number. If you carry a balance, that number is costing you money every single month. Pay it down aggressively. Pay in full when you can. Stop letting compound interest work against you. Third, learn the spread. Every time a financial institution offers you a product, ask yourself who benefits from this more. The answer is almost always them, not because they're evil, but because that's how the business works. And the only defense against a business model built on your confusion is understanding it. Interest rates are not complicated. Banks just need you to believe they are. Because the moment you understand how the spread works, you stop being the person on the wrong side of it.